All right. Hey there, ladies. How's it going? Hope you're doing well. Welcome back to another Flip lecture. Today we're going to be covering Chapter 8, which is Business Organizations. These are some of the key vocabulary words that you should be able to define by the end of this unit. You should have already taken notes from your textbook, so you want to make sure that you can identify all of these terms. They will be on the test. So based on your reading, please answer the below question. To determine whether a business made a profit, you must what? A, subtract total expenses from receipts. B, subtract taxes from other expenses. C, subtract the cost of new equipment from income. Or D, subtract wages from receipts. So take a moment and think of your answer. The answer is A, subtract total expenses from receipts. Good. So what is an entrepreneur? An entrepreneur is a person who organizes, manages, and assumes the risks of a business in order to gain profits. That's one of the biggest parts, is that they assume the risk of a business in order to gain profits. One of the biggest pros is that they get to be their own boss. And an entrepreneur must gather the relevant factors of production to produce. They must know all laws, all regulations, and all tax codes. One good thing about small businesses is that there is help available. There's help from the federal government and from local government oftentimes. The federal government has the Small Business Administration, which often helps to finance startups or new small businesses. Each state often has departments of commerce and community affairs, which can help give grants and help with organization for small businesses, as well as just giving information. And community colleges and university campuses often have business development centers that are federally funded. I thought that was particularly interesting because it was something that I wasn't as familiar with. Another way is that for entrepreneurs to get information is from the internet. There's tons and tons of information available on the internet, but then there's also opportunities for funding. And these were not in your textbook because I think your textbook was published before the advent of things like Kickstarter or GoFundMe. So Kickstarter, if you're not familiar with it, is a place where people can give money. So a person will state a goal, and then people give money, and then in return for some type of benefit. So it changes, right? But it's a little bit like selling stock, but without actually selling stock. Another opportunity is something called GoFundMe, and this is where people just ask for money. Oftentimes GoFundMes tend to have an emotional appeal as opposed to just a financial appeal, whereas Kickstarter tends to be a little bit more about funding businesses. All right, so there are several elements of business operation. They include expenses, advertising, record keeping, and risk. Expenses. You have to spend money to make money is the general adage that most businesses work by. For example, you have to buy new equipment, you have to pay wages, you have to pay for insurance, pay taxes, pay for bills like electricity, telephone service. All of those basic things make starting a business really, really expensive. And that's one thing you always want to budget for if you're starting a new business is all of those startup expenses. That's often where companies tend to run into a little bit of trouble. They tend to underestimate startup expenses, and things always end up being a little bit more expensive than they think. Advertising is another really expensive element of business operation. You have to make customers aware that your goods or services are even available for a price. The cost of advertising can cut into profits, especially in the startup phase of a business, right? So those initial advertising costs to make people aware that your business even exists tends to be very, very expensive. Record keeping is also another important element. You have to maintain accurate records of your expenses and receipts, especially when you're doing your taxes. And we'll go into that in a little bit about why record keeping is so important, especially for taxes, in part because Well, I'll tell you in a second. All right, and risk. Many startups fail. If you work for a boss, your overall risks are usually small because the boss is the person taking on the risk. But as your own boss, your risks are much, much greater, but so are your potential rewards, right? So the risk overall is higher when you are a startup or if you are an entrepreneur. All right, so what are sole proprietorships? Sole proprietorship is a business owned and operated just by one person. So sole proprietors get to be their own boss and they get to be creative. If it does well, cha-ching, they get all of the money and all of the profits. But one of the cons is that it's very demanding and time consuming. And if it does poorly, the proprietor assumes all of the risk, aka unlimited liability. And in fact, if it does poorly and say the business fails and they're in debt, that person's personal assets can actually be seized as collateral for any loans that they're unable to pay back. So in that case, it's unlimited liability, right? All of that liability falls on that one person. So partnerships are a different form of a small business, and partnerships are businesses that two or more individuals own and operate. They sign an agreement that is legally binding, and a partnership's borrowing potential is generally very, very good. Partnerships' value of personal and business assets is bigger than a sole proprietorships, right? Because you have two people's personal and business assets, or two or more, as opposed to just one person's personal assets. So they tend to be able to borrow more, which is good if you have very expensive startup costs. There are a whole bunch of different types of partnerships, but three in particular that we're going to cover are a limited partnership, limited liability company, and a joint venture. So a limited partnership is a special form of partnership in which one or more partners have limited liability but no voice in management. So the general partner, generally this is the founding partner, assumes all of the management duties and has full responsibility of the debts of the partnership. And then these other partners come in and they provide some finances, some financial help, but they have limited liability, as in only very limited kind of responsibility for those debts. But then they also have no voice in the management of the company. So they're kind of these shadow partners. Then you also have limited liability company. And a limited liability company is a type of business enterprise that protects members against losing all of their personal wealth. Members are taxed as if they were in a partnership. And then the last kind is a joint venture. A joint venture is a partnership set up for a specific purpose for a short period of time. When, for example, when investors purchase real estate and then flip it and sell for a profit. So let's pause for a second just before we launch into the big corporations. Why do you think most products you buy are produced by corporations? Maybe jot down a few notes here in response. Okay, so corporations are a type of business organization that are owned by many people, but treated by law as though it were a person. A corporation can own property, pay taxes, make contracts, and so on. Their objective of corporations is to be large, to grow, and to produce sustained returns for the people who own the business, aka make money for stockholders. So how the heck is a corporation legally a person? A very, very important Supreme Court decision called Citizens United established the precedent for this. So the Supreme Court ruled that corporations have the right to spend money in candidate elections, and that some for-profit corporations may, on religious grounds, refuse to comply with a federal mandate to cover birth control in their employee health plans. These are personal rights according to corporations. To many, the concept of corporations as people seems odd to say the least, but it is not new. The dictionary defines corporation as a number of persons united in one body for a purpose. Corporate entities date back to medieval times, observes Columbia Law professor John Coffey, an authority on corporate law. You could think of the Catholic Church as probably the first entity that could buy and sell property in its own name. Indeed, having an artificial legal persona was especially important to churches. Having a corporation would allow people to put property into collective ownership that could be held with perpetual existence, so it wouldn't be tied to any one person's lifespan or subject necessarily to laws regarding inheriting property. So this article goes on. I highly suggest that you read it. It's really, really a fascinating story. It's 8 minutes long, and it's available at this link above, NPR. I'll include a post to the link in Schoology so that you can click the link. You do need to be familiar with this both for this semester, but also for next semester as we start talking about the Supreme Court cases for AP government, AP US government. So you really definitely want to listen to this. So I would go ahead and pause this, click this, and familiarize yourself with the Citizens United case. It's very, very important and quite controversial. All right, this is another clip that I'd love for you to take a peek at. This is from a documentary called The Corporation, in which I know you won't have time to watch the whole thing, but I will also post the link for this. It is a fascinating documentary in which it explores what a corporation is. It does talk about the Citizens United case a little bit. Here.
Black people. And therefore, it said no state can.
The corporation was considered a subordinate entity that was a gift from the people in order to serve the public good. So,
Oops.
Imperial Steel Incorporated has many of the legal rights of a person. It can buy and sell property. It can borrow money. It can sue in court and be sued. It carries on a business. Imperial Steel, along with thousands of other legal persons, is a part of our daily living. It is a member of our society.
Having acquired the legal rights and protections of a person, the question arises, what kind of person is the corporation?
Corporations were given the rights of immortal persons, but then special kinds of persons, persons who have no moral conscience. These are a special kind of persons which are designed by law to be concerned only for their stockholders and not, say, what are sometimes called their stakeholders, like the community or the workforce or whatever.
The great problem of having corporate citizens is that they aren't like the rest of us. As Baron Thurlow in England is supposed to have said, they have no soul to save and they have no body to incarcerate.
I believe the mistake that a lot of people make when they think about corporations is they think, corporations are like us.
General Electric is a kind old man with lots of stories.
Nike,
Young,
energetic.
Microsoft, aggressive. McDonald's, young, outgoing, enthusiastic.
Monsanto, immaculately dressed.
Disney, goofy.
The Body Shop, deceptive.
Very lovely.
Do you know what the Body Shop is?
They think they have feelings, they have politics, they have belief systems. They really only have one thing, the bottom line. How to make as much money as they can in any given quarter. That's it.
Of course they make a profit, and it's a good thing. That's the incentive that makes capitalism work, to give us more of the things that we need. That's the incentive that other economic systems lack.
People accuse us of only paying attention to the economic leg because they think that's what a business person's mindset is. It's just money. And it's not so, because we as business people know that we need to certainly address the environment, but also we need to be seen as constructive members of society.
There are companies that do good for the communities. They produce services and goods that are of value to all of us, that make our lives better, and that's a good thing. The problem comes in the profit motivation here, because these people, there's no such thing as enough.
And I always point out there's no organization on this planet that can neglect its economic foundation. Even someone living under a banyan tree is dependent on support from someone. The economic leg has to be addressed by everyone. It's not just a business issue.
But, unlike someone under a banyan tree, all publicly traded corporations have been structured through a series of legal decisions to have a peculiar and disturbing characteristic. They are required, by law, to place the financial interests of their owners above competing interests. In fact, the corporation is legally bound to put its bottom line ahead of everything else, even the public good.
That's not a law of nature. That's a very specific decision, in fact, the judicial decision. So they're concerned only for the short-term profit of their stockholders, who are very highly concentrated.
To whom do these companies owe loyalty? What does loyalty mean? Well, it turns out that was a rather naive concept anyway, as corporations are always owed obligation to themselves to get large and to get profitable. In doing this, it tends to be more profitable to the extent it can make other people pay the bills for its impact on society. There's a terrible word that economists use for this called externalities.
An externality is the effect of a transaction between two individuals on a third party who has not consented to or played any role in the carrying out of that transaction. And there are real problems in that area, there's no doubt about it.
Running a business is a tough proposition. There are costs to be minimized at every turn. And at some point, the corporation says, let somebody else deal with that. Let's let somebody else supply the military power to the Middle East to protect the oil at its source. Let's let somebody else build the roads that we can drive these automobiles on. Let's let somebody else have those problems. And that is where externalities come from. That notion of let somebody else deal with that. I got all I can handle myself.
So this is a absolutely fascinating documentary. It's available on YouTube. It's just called The Corporation. It goes on, and I would highly, highly recommend it if you have a chance to watch it. I will also post the link to it in Schoology. All right, so one of the pros of becoming a corporation is that they have things like limited liability. If a corporation goes bankrupt or is sued, the stockholders' losses are limited to their investment in the firm, right? So their only loss is whatever they paid for the stocks. The biggest con is that corporations are taxed more heavily than other forms of business organizations. As you saw, one of the potential reasons for that is that they are using things like government infrastructure to get their goods to consumers. All right, so what does it take to become a corporation? To become incorporated, the company corporation must register with the government of the state it will be headquartered in. It must sell stock, and it must elect a board of directors with the input of shareholders. All right, so registering the corporation. They do this through something called the Articles of Incorporation. That's a term you need to know, the Articles of Incorporation, which is when a document listing basic information about a corporation that is filed with the state where the corporation will be headquartered. It includes the name, address, and purpose of the corporation, the names and addresses of the initial board of directors, the number of shares to be issued, and the amount of money capital to be raised through issuing stock. A corporate charter is the license to operate, which is granted to a corporation by the state where it is established. That's important. It's granted to operate in the state where it is established. So if a corporation was established in Utah, that's where the corporate charter would be held. All right, selling stock. Common stock gives the investor part ownership in the corporation, as you learned in Chapter 6, a right to a percentage of the company's future profits, and voting rights at the annual stockholders meeting. It does not guarantee a dividend, right? We talked about that when we talked about risk and how risky stocks can be. Preferred stock are shares of ownership in a corporation that give stockholders a portion of future profits before any profits go to holders of common stock, but they have no voting rights. Again, that's a term you read in Chapter 6. All right, naming a board of directors. So partners select the very first board of directors, but then all other boards are elected by stockholders. And they include a set of bylaws, a set of rules describing how stock will be sold and how dividends will be paid. The board hires the president, the vice presidents, secretary, and treasurer to run the business and to hire other employees. But what about the CEO? You always hear about CEOs. Who hires the CEO? A CEO is the top executive responsible for the operations and management of business. While a CEO often doesn't oversee any one department, he manages an executive team that oversees top-line directors and managers. A CEO helps set annual budgets, strategic management goals, and profit targets. CEOs serve board of directors, helping create the tactics that support board strategies. Okay, so that's the key part. So the board hires the CEO. For example, if a board sets a goal of paying a quarterly dividend, a CEO will reserve company cash rather than use it to pay down debt or buy assets. If a nonprofit board sets an annual revenue goal, the CEO will work with the development department to create fundraising and sponsorship goals. Okay, so it goes on and on. And that's from the website work.cron.com. All right, so application. Take a moment and just think about, what are the major advantages of becoming a corporation? Why would somebody want to become a corporation? So think about that. You may want to watch a little bit more of that documentary just before you answer this question. It can be particularly helpful for this question. But one of the biggest pros is limited liability. If a corporation goes bankrupt or is sued, the stockholders' losses are limited to their investment in the firm. But one of the biggest cons is that they're taxed more heavily than other forms of business organizations. All right, so pause for a second. Can you define corporation? Can you identify the pros and cons of a corporation and the requirements of a corporation? Can you explain the Citizens United Supreme Court decision? If not, go back and review those slides. If you can, you're free to move on to franchises. All right, so franchises. As you might have determined from that picture on the right, a franchise is an arrangement in which a person or group obtains the right to use the name and sell the products of another business. Franchisor. One thing you want to be familiar with is franchisor versus franchisee. The company, McDonald's, is the franchisor. The person who buys a small McDonald's and runs the McDonald's in, on Burlingame Avenue, I don't think there is one, but let's pretend there is the franchisee. Okay, so fees. The franchisee pays a fee to the franchisor that may include a percentage of all revenues taken in, and franchise rules. The franchisee must meet certain quality standards. So I can't ask the franchisor of, let's say, Subway, to run a franchise, agree to run a franchise, and then serve really gross moldy bread, or decide that we aren't going to bake our fresh bread, we're going to buy Costco bread and use that instead because we don't like the bread. It's too expensive. It doesn't work like that. I have to agree to use their product and uphold their brand name. One of the biggest perks... let's take a moment. Why don't you think about the perks? So what are the pros and cons of opening a franchise? All right, one of the biggest pros is name recognition, right? Everybody, you kind of recognize Subway or you recognize Denny's. So you know that they already have built the brand. So you've got the name recognition. They also already have a proven way of doing business. But one of the biggest pros is that the parent companies will pay for advertising. Think about all the ads that you see on TV, or on the radio, or on the sides of buses for McDonald's, Burger King, Wendy's, Pizza Hut. The list goes on and on. But advertising, as you saw, can be one of the most expensive things for startup costs, one of the biggest expenses for startup costs. So if the parent company is going to pay for your advertising, that's huge. All right, success rate is also the last pro is that the success rate is much higher than independently owned businesses, right? We learned how it can be really tough. There's a relatively high fail rate for independently owned businesses. So franchises have a much higher percentage of the success rate. One of the biggest cons is the loss of control for franchisees. Because you have to sell their product. You don't have any say in the product. If you don't like the product, it doesn't matter because you've agreed to sell the product no matter what. So you have to sell the product. You also can run into legal trouble if one party fails to hold up its side of the agreement. So say I decide I want to use Costco bread and I just think maybe they won't notice. The franchisor could sue me for that. And it could be bad news bears. All right, so why don't you explain very briefly, make sure that you can apply this concept. Why is franchising less risky than being a sole proprietor? Try to use some key terms in there. Try to incorporate them into your response. All right, and that brings us to the end of Chapter 8. I will do a separate lecture for Chapter 9. Let me know if you have any questions by posting them in the Schoology discussion forum, and I'll try to answer them within 24 hours. Hope you guys are doing well. Bye.